Hi everyone, we're continuing this week with risk and return for the overview. And in this module, we're going to go over the distribution of returns across asset classes, standard deviation and volatility, risk and return, the Sharpe ratio, the NPV of equity investments, intro to equity valuation, and the residual earnings model. So let's see here. So what is the distribution of returns across asset classes? Obviously, the more risk there is, the more return there is. So equity securities traditionally have more returns than bonds, and bonds have more return than safer bonds, right? So the standard deviation volatility really kind of goes into that as well in terms of connecting to volatility of riskier securities is usually higher. And that means what is the standard deviation? Standard deviation is really what is the average deviation from the mean. So if we measure deviation on a regular basis and we're measuring exactly the returns. So if the returns on equities on average are 7%, which they are for the S&P 500 for the last 100 years, the standard deviation of the S&P, I believe, is about 20%, 21%. So that means that on average, the return of the S&P is 7%, and also on average, it is 21% away from 7%. So in other words, the average deviation is 21% from 7. So we're going to go over what is that, what does that mean, what's going on. So obviously a good investment is when you have a situation where a return compared to risk is a higher ratio than another investment. So return divided by risk. And what does risk mean? Risk means the volatility. So when the return exceeds the volatility, it's considered a very high quality investment. So example, you can invest into an equity security and it returns, say, 10% one year, but another year it could return negative 12. So the idea is not necessarily to always have a great, huge positive return, but maybe you invest into a bond portfolio and it returns 6% a year. That could be superior than equities returning 20% one year, 2% the other year, negative 8 the other year. So the volatility is very important. So what happens in terms of what creates value in the corporate setting is this idea, besides strategy, we can look at a few things that create value in the corporate setting. It could be minimizing the cost of capital. So minimizing your risk can actually increase your stock price, growing through innovation, global markets, innovation and productivity, improved margins, new industry, being a first mover, business strategy, owning less assets, having higher asset turnover, and cost. So all these ways are to increase value in the business. Ultimately, can reduce your risk. Ultimately, what drives value is higher returns. That actually reduces your risk. So these are different asset classes that pretty much go from low volatility to high volatility, with derivatives being more the high volatility, small cap stocks being more volatile and having more returns as well. The other ones we mentioned previously. What is standard deviation? As we saw here, this is the equation that kind of says what is the deviation per each year, for example, of a return. Then we square those. We divide them by the number of years you looked at, and then you take the square root of it. Essentially, it's the average of how far away a result falls from the mean. You kind of figure out all the differences, add them up, then divide them by the number of points in the data set, and then you square root it to figure out what's the average deviation from the mean. And this tells you, if it's 20, it's for the S&P 500, it's about 20. If it's 30, it's for small stocks, it's even higher. So you could kind of see that, oh wow, I'm buying something that returns 7% a year, but usually it's off by 20 points. So you have to understand, okay, maybe I want something a little bit less risky. So this is what we're looking at. This week we're also going to look at valuation models and start looking at, okay, how do you use these inputs to actually value a stock? And we'll do an exercise as well.